Welcome back. So, we are talking about the beta of the hedge portfolio and we are trying to derive an expression for the beta. We had worked out this expression up to the point of the expected value of the investment, the initial investment has been written in terms of the hedge beta. Now, this expression, this is the return on the combined hedge plus the cash position plus the hedge position on the combined on the two combined together give us this expected return, and therefore, we have introduced a new beta which is the beta of the combination of the cash and the hedge position, and we have written it as beta h. And substituting the respective values for RS and RF from these equations, and noting, please note here, I reiterate once more that RF is not present in the case of the futures return, because there is no initial investment and therefore, there is no funds locked into the system and no opportunity cost of funds, and therefore, this RF quantity factor, RF factor does not arise when we work out the expected value of RF. The risk free return does not arise when we talk about the expected value of the futures position. Setting these respective values, we get beta h, and comparing the two, we get beta h is nothing but beta of the spot position minus value of the futures position at t equal to 0. Whatever value you have taken of the futures for the hedge at t equal to 0 divided by the cash position at t equal to 0 into beta of the futures. Now, in the case of index futures, beta f is usually taken as 1 because they represent the market portfolio. So, beta of f is usually taken as 1. And now, if you want a perfect hedge or the best possible hedge, the complete systematic risk should vanish. This complete systematic risk will vanish only when beta h is equal to 0, beta of the hedge position is 0, and that gives us an expression for our futures exposure that we need to make in order to achieve hedging of our cash position, and that works out to beta s into the value of the spot position divided by beta f. Beta f, as I mentioned earlier, will be taken as 1 in most cases, but for the moment let it remain. Now, and what about the number of contracts? The number of contracts is nothing but the value of the futures position, divided by value of one contract. What is the value of one contract? That is equal to the size of the contract or the lot size multiplied by the futures price per unit. So, at the end of the day, what do we get? We get n is equal to beta s into I of s divided by beta f into this value, which is nothing but z into f 0. This expression is nothing but this, the value of one futures contract, and what is f 0? That is the futures price per underline. So, this is the expression for the number of contracts, number of futures contracts that we need to have for complete hedging of the systematic risk, complete beta hedging. This is another way of deriving the same expression, absolutely similar, same result. Okay, let us do an example. A portfolio manager has a portfolio of long positions in stocks valued at $1.5 million. A portfolio manager has a portfolio of long positions in stocks valued at $1.5 million with a beta of 1.50 at t equal to 0 when the S&P 500 index is 1500. S&P 500, this is the spot index, this is not the futures value, this is the spot index. Spot index is 1500 at t equal to 0, the beta of the portfolio is 1.50. The value of the portfolio is 1.5 million. He desires to hedge this portfolio for a period of 3 months. 3 months using S&P 500 index futures with a maturity of 4 months As I mentioned, it need not necessarily be that our hedge period be coincident with the maturity of the futures, it can always be less than that. The index has a continuous compounded yield of 4% and the risk free rate is 10%, also continuous compounded. The contract multiple is 250, this is Z. Calculate the number of contracts, number 1, and then he says if the index actually falls by 10% at the end of 3 months, which is our hedge period. So, at the end of the hedge period, if the index falls by 10% from its original value, assess the performance of the hedge. So, first step is calculation of the number of contracts. Now, we will go this very slowly because this example exemplifies everything about the number of contracts that we talked about algebraically in the previous slides. Spot value of the index is 1500, risk free rate is 10%, yield on the index is 4%, maturity is 4 months. For the futures contract, hedge period is 3 months, remember that. No arbitrage futures price of the index, no arbitrage futures price of the index is given by, this expression is given by S0 e to the power r minus q into t. S0 is 1500, r is 10%, q is 4% and t is 4 months. If you put these respective values, you get the futures value of the index is 1530.30. This is the futures value of the index at t equal to 0. This is equal to F0, futures value of the index at t equal to 0. This is the value, futures value of the index, not the contract. You multiply it by 250 and you arrive at the futures value of per contract, per futures contract, and which turns out to be 382575. So, this is the value per contract. This is what we had as V star F. This is F0, this is V star F and this is Z. Our exposure is 1.5 million, beta is 1.5. So, how do we get the number of contracts? 1.5 million into beta, that is the spot position, into beta S divided by V star F. This gives us the number of contracts and this turns out to be 5.88. This into this divided by this, 1.5 into 1.5 million divided by 382575 gives us 5.88, which is rounded off to 6 contracts. So, we hedge by taking a short position in 6 stock index futures of the given choice, S&P stock index futures. Now, let us do the evaluation of the hedge. First, let us look at the futures position. Now, the hedge period is 3 months, decline in index at the end of the hedge period is given as 10%. Therefore, the value of the index, the cash value of the index, spot value of the index at the end of the hedge period, this is at t equal to 3 months. The cash value of the index at t equal to 3 months is 10% lower than what we started with. We started with 1500. So, now it is 1350. The risk free rate is so much, this is this. So, what is the no arbitrage price? Now, remember the futures still have 1 month of expiry still to go. So, the futures price will not be this, it will not be this, it will not be this. Convergence does not apply for this. Convergence will apply on maturity of the futures, which is still 1 month away. So, the futures price, the no arbitrage futures price as of now will be just like we worked out earlier, F3, let us call it F3 is equal to S3 e to the power r minus q. Now, it will instead of 4 months, because at that time we had the futures had a maturity of 4 months. Now, the futures have a maturity of 1 month into 1 by 12 and that works out to 1356.767, 1356. This is the cash value, this is the futures value as at T equal to 3 months. So, in effect what have we done? We have taken a short positions at in 10 futures contracts at 1530 and we have liquidated it at a futures value of 1356. We took a futures position at 1530, 10 futures and futures contracts and we liquidated them at 1356. So, what is the profit? The profit works out to this much. Remember, we are short. So, there is a decline in prices, we have made a profit. So, the profit is 1530 minus this expression into 250 into 10 and that works out to this much 260302. So, this is as far as the futures are concerned. You have made a profit on the hedge. This is the profit on the short futures, which is the hedge. Now, let us look at the cash position. The index has lost 10%. However, the index has a yield of 4% per annum. Therefore, in 3 months, the index has given us a return of 1%. The index has grown by this due to the yield, although index has lost 10%. In other words, the net loss is not 10%, the net loss is 9%, because 1% has been recouped because of the yield. The yield per annum was, if you recall, the yield per annum was 4%. So, the yield for 3% or 3 months is 1%. So, out of this loss of 10%, 1% has been recouped through the yield and the net loss is 9%. This is as far as the index is concerned. This is the market return. Market has declined by 9%, not by 10%. The index has simply declined by 10%, market has declined by only 9%. The risk free rate for 3 months, there is 10% per annum. Therefore, the risk free rate for 3 months works out to 2.5%. The beta is given as 1.5. So, we use the CAPM model. What is the CAPM model? The CAPM model says RP is equal to RF plus beta P RM minus RF. RF is this much, this is RF, this is RM and this is beta P. So, everything is with us and we find that RP is equal to 14.75% minus. So, apply this 14.75% on our initial exposure of 1.5 million. In other words, our portfolio has declined by 221250. This is the decline in value of the portfolio, value of our portfolio which we started with. So, what is the net result? The net result is that we have made a loss of this much on the cash position, but we have made a profit of this much on our futures position. So, we are still in the green and the amount that we are in the green is 39052, which works out to a return of about 2.6%, which is roughly close to the risk free rate. The aberration is due to certain basis risk, the number of contracts rounding off and it is very close to our risk free rate of 2.5%, it is 2.6%. So, this example literally covers a lot of in a lot of detail about how the futures hedges operate when we talk about hedging of portfolios using index futures. Another simple example, it is July 16, a company has a portfolio of stocks worth $100 million. The beta of the portfolio is 1.2, beta of the portfolio is 1.2. This is the current beta, this is the cash value of the portfolio. The company would like to use CME December futures on S&P 500 to change the beta. To change the beta, now this is simply managing of beta and it wants to reduce beta. It is a long position, it wants to reduce beta, so it has to go short. The index futures price is currently 1000 and each contract is 250 times. This is the contract multiple. What position should the company take? Obviously, a short position, and Suppose that the company changes, this is the second part of the problem. Let us do the first one. Now, since the company wants, as I told you, it will take a short position. The hedge beta is given by beta s, we worked out this formula, beta s minus Vf upon Is. Obviously, there is a beta f here, beta f is usually taken as 1. So, we have beta h is equal to beta s minus Vf upon Is. So, that 0.50, which is the new beta that we want, is equal to 1.20, the old beta, this is the old beta, the spot beta, the cash beta minus Vf. Vf is what we have to find out, the value that we have to take in the futures market divided by 100 million, which is our exposure in the spot market. Vf works out to 70 million. The number of contracts, the value in the futures market divided by the value per contract, which is 250 times the current index value, which is nothing but 280. You can see, if you have a look here, the current futures price is 1000, the index multiple is 250. So, the current value of a futures contract is 250 into 1000, and we worked out that the exposure in the futures market for the hedge is 70 million. So, 70 million divided by 1000 into 250, that is equal to 280, which constitutes the number of contracts. As far as this formula is concerned, you can again go back and have a look. Yes, beta h is equal to beta s minus value in the futures markets, the value of the hedge divided by the exposure, the cash exposure into beta f, which is 1. So, once we know this here in this particular problem, we know beta h, we know beta s, and we know the initial exposure. So, we find out the value of the futures that we need for the hedge, we divide it by the number of by the value per contract to arrive at the number of contracts. This is a similar problem, you can try it, absolutely similar to the problem that we did just now. It is an extended problem where we are trying to work out the profits and losses of the net of the hedge. We worked out the profits of the futures position, we worked out the losses on the cash position corresponding to, that is important, corresponding to different values of the index, in fact different scenarios. What we work out the performance of the hedge corresponding to different scenarios as represented by different values of the index. Now, we have always been emphasizing about arbitrage. The no arbitrage price of a futures, we all know, if you use simple interest, then it is this one. If you use compounding at discrete intervals, it is this, and if you use continuous compounding, it is this expression. They are this is a first order approximation of this, and so on. These are the no arbitrage values of futures contracts. Now, just like we have arbitrage in the spot versus futures markets or forward markets, and we talked about how cash and carry arbitrage can take place, reverse cash and carry arbitrage can take place, and similar things can happen in the futures market also, provided an aberration or a scope for arbitrage does exist. We will have cash and carry arbitrage if the futures market or the futures price exceeds this or exceeds the current spot price or the cash price plus the net carrying cost. In other words, if the forward price or the futures price exceeds the net carrying cost, you will have a scope for cash and carry arbitrage. What you do is you take a cash position in the index or a portfolio which is as close to the index as you can get, and you sell that in the futures market, sell the index in the futures market, and thereby you achieve cash and carry arbitrage. Conversely, if the futures value of the index is less than your spot value or the cash value of the index plus cost of carry, you will have reverse cash and carry arbitrage. You will buy in the futures market and you will sell, you will short a portfolio of stocks which epitomizes or which is similar to the index, underlying index of the futures contract. However, there are certain limitations. First, let me talk about the limitations, then I will come back to this. You see, traders may buy or sell a proportion of the stocks in the index. They cannot exactly replicate the index. So, that could be a cause of a basis risk when you talk about arbitrage. Transaction costs invariably are there, market frictions are there. So, they would eat into the arbitrage profits. Discreteness in the contracts, you cannot have a continuous spectrum of contracts. There will be contracts will be in discrete values, discrete multiples. If there is any payment of dividend, payment of yields, the uncertainty associated with the payments of yield could cause basis risk, and then the spot and futures position may not be taken at the same time, and that may also create as an element of basis risk. To recap, the most important thing is you may not be exactly able to replicate the index which forms the underlying of the futures, stock index futures, and this may create a significant basis risk when you talk about arbitrage. Other transaction costs are there, discreteness of contracts we have already talked about, that creates basis deviations, basis risks, and timings or the time lag between taking one position and the other position may also contribute to non-neutralizing the two. Let us get back. So, we have so far been talking about arbitrage without involving transaction costs. When we have transaction costs like bid ask spreads, borrowing lending spreads and so and brokers commission, etc., then we cannot exactly specify the no arbitrage price. We can establish bounds for the no arbitrage price. Let us take an example. We are talking about cash and carry arbitrage. Remember, in the cash and carry arbitrage concept, the spot price plus the carrying cost is less than the futures price. So, we take a long position in the spot and a short position in the futures market. So, what do we do? How does it operate? Let us look at this. We borrow a certain amount. Now, in this case, how much do we have to borrow? We are going to buy the asset in the spot market. When we are going to buy this asset in the spot market, we will have to pay the ask price, not the bid price. Bid price, when you sell the asset to the market maker, it is the bid price. When you buy the asset from the market maker, it is the ask price. So, because you are going to buy the asset from the market maker, you will have to pay the ask price, plus of course, you will have to incur the transaction cost. So, the total amount that you have to pay when to acquire 1 unit of the asset, say, is S naught ask plus the transaction cost related to the ask transaction, and this is the amount that you have to borrow. Remember, in this case, bid and ask are different and borrowing and lending are also different. In fact, transaction ask and transaction bid are also taken as different. So, you borrow this amount, and by with this amount that you have borrowed, at what rate? You borrow it at RB, because it is a borrowing rate. So, you buy that asset, you have to pay this is your outflow. You borrowed the asset, it was an inflow, and you bought the asset, this was an outflow. Now, you have 1 unit of the asset with you, you have no cash with you. At time t equal to tau, you receive a certain amount of dividend and you invest that amount of dividend. So, at this point t equal to tau, the net cash flow is 0. Let us see what happens on maturity. On maturity, you deliver the asset. So, the asset that you had here plus 1 cancels with the minus 1 that you had here. You have no holding of the asset, that is cancelled. You receive the forward price, which what is the forward price? That is F naught, or that you have worked out, or that was worked out, or at t equal to 0, that is the futures price or the forward price. Now, you have you have invested the amount of dividend. So, you receive a certain amount from the dividend amount, which is given by this amount. The amount of dividend that you invested plus the interest thereon for the period of investment. Now, this is calculated at R lending, because the lending rate, because you have made the investment. So, because you have made the investment, you invest at the lending rate, you borrow at the borrowing rate. So, here you have made the investment. So, it is a lending rate. And how much you have to pay for the borrowing that you made at t equal to 0 for acquiring the asset, that is S ask plus the transaction cost in relation to the ask transaction into 1 plus R b into t. Now, in order that no arbitrage takes place, you see here there is no net cash flow, here there is no net cash flow, the only cash flows are occurring here. So, because there are no cash flows here, no cash flows there, and you do not want arbitrage to operate, that means the net cash flow here must be less than 0, and that gives you that f 0 plus this thing minus this thing is less than 0, or f 0 is less than this minus this, as f 0 is less than this minus this. That is, this is the bound, this is the bound that will ensure that no cash and carry arbitrage takes place, no arbitrage requirement gives you this particular bound. Similarly, we can work out the reverse cash and carry arbitrage. In the case of reverse cash and carry arbitrage, what happens? You will borrow the asset and you will short sell the asset. When you short sell the asset, you will see you are selling the asset, so you will receive the bid price. Because you are selling the asset, you receive the bid price. Now, out of this bid price, you will have to incur transaction cost. So, the net receipt that you get is S bid minus the transaction costs related to the bid transaction, and this is the amount that you invest. Now, because you are investing, you will invest at the lending rate. So, I repeat, you borrowed the asset, you sold it in the market. Because you sold it in the market, you get the bid price. Again, you have to pay brokerage and other transaction costs, that is an outflow. So, that gets subtracted from the money that you receive as a result of selling the asset, and the net amount you invest. As far as dividend is concerned, you borrow the amount of dividend to pay it to the original owner, and by borrowing the amount, you satisfy the claim of the original owner who owns the asset. Obviously, he is entitled to the dividend. So, you give him the dividend, but because you have borrowed this amount, you have to repay this amount, and this shows the repayment of the dividend amount that you have borrowed. And please note, here you are paying an interest, and because you are paying the interest, you will pay it at R b. Now, what happens on maturity of the forward or futures? You receive the asset under the forward contract, and you replenish the asset to the original owner. So, the asset gets cancelled, the asset that you have borrowed has been replenished, has been repaid, right. So, that is done. Now, what about the borrowed dividend? You repay the borrowed dividend at R b, and you receive the proceeds of the investment which are given by this. Now, this will be at R lending rate, because it is an investment by your side. It's an investment, so it will be at the lending rate. Again, we require the same condition, that since there is no cash flow at t equal to 0, there is no net cash flow at t equal to tau. Therefore, for no arbitrage, the cash flow here must also be it cannot be positive, it must, and because it cannot be positive, this whole expression must be less than 0, and that gives us this that gives us the lower bound for the forward price. One simple example to conclude this topic. Suppose the current index is 200, the risk free rate is 10% and the yield is 3%. The maturity of the futures is 4 months, and the futures price as prevailing as in the market now is 210. We have to identify whether there is an arbitrage possibility or not. It's simple straightforward problem. Let us do it. Using that formula S 0 is equal to E R minus Q T, we find that the no arbitrage forward price or the futures price is 204.72. However, the actual forward price or actual futures price is 210, and therefore, there is clearly a possibility of arbitrage. The second thing we find is that the forward price or the futures price is higher compared to the stock to the cash price plus cost of carry, and as a result of which what we will do? We will do cash and carry arbitrage. We will buy the underlying asset, buy the index, whatever is the underlying in the cash market, and we will take a short position in the futures market and thereby make the arbitrage profit. The cost of the index is so much, risk free rate is so much, yield is 3%, maturity is 4 months, that is this much. The amount that you need, no, the important thing is, because there is an yield of 3%, the amount that you need to borrow is only 198.01. It is not 200. Part of the amount is covered by due to this. You do not have to, in other words, what I am trying to say is, on maturity, when you have to deliver 1 unit of the index, you do not have to invest in 1 unit of the index at t equal to 0. You can take a lower amount of index, because of the yield that will transform into 1 unit of the index on maturity of the futures contract. So, you buy the index worth this much amount rather than the 1 full unit of the index, buy this much of index which will grow to 1 unit on the date of maturity, and that is after this much time, deliver it against the forward futures commitment, receive the cash from the futures, this is what you are going to receive, repay the amount borrowed, that is this much amount plus interest, that is 204.72, you make a profit for it 5.28. Thank you.